but that's okay.
I think, okay. Okay, let me go get my tea. Yeah, important.
Are we recording already? Preeti,
Yeah,
are we recording already?
I got a message.
Yeah, I got a message too.
Yeah. I think Rosie has started that. She started the recording.
Yes, I just started that.
Yeah. Okay. So I think Rosie, once it is 5 o'clock, then please unmute everybody other than Tanya, Rakhi, Ashima, and me.
Yeah.
Okay, and we will just stay on the video. I will simply make a simple housekeeping announcement at the beginning, which would be to request people to ensure that
Can't hear.
You can't hear?
Can't hear. Couldn't hear.
Now it's better.
Now
Yeah.
what?
Maybe you'll have to just come a little closer, Preeti.
Can you hear me now?
Yeah, yes.
Better. Yeah.
Oh, good
Better
God. Okay, so I'll really be very quick, okay, and I'm going to be very loud so nobody has this. And
The voice is breaking actually. Your voice is breaking.
It wasn't Kitty for me. The voice is not breaking.
Ah, okay.
Yeah, I could hear her properly.
Okay.
I will anyway not be speaking much, so it doesn't matter as such, hopefully. I will introduce Tanya, and then after that, after the initial housekeeping piece, with asking people to stay muted and to raise their questions in the end. One way, we will unmute people and request them to ensure their video is on when they are asking the question. It would be a good idea for people to put down their name in the chat and say that they have a question so that when we finish, we can go sequentially and have them basically answer those questions in a sequential manner. Tanya, is that okay with you?
Yeah, fine.
Okay, great. So I think we will start at 5:05. We just give 5 minutes for people to join. Hi, Rekha. Hi, Pushkala.
Hi, Pushkala. I just want to say hi to Yenny.
Hi, Pushkala.
Good evening. Hello.
Hi, Rekha.
Hi, Smita.
Hi, Anjali. Can see you. You're joining from Kolkata. Where are you based?
Can you just unmute Yenny Udon for a minute?
Rosie, just unmute everybody till 5 p.m.
Okay.
We start muting everybody when Preeti has done with her welcome speech at 5:05 when we start the session.
Yeah, that's great.
I think everybody is on
everybody.
mute
I'm
now.
Anjali Banerjee.
No, I think Yenny is still
logging in from
Yenny is still
Kolkata.
muted.
I'm logging in from Pune.
Great. That's great, Anjali. Lovely to see you.
You too. So I used to be Bhagyashri Zog. Now I am Anjali Banerjee, and I'm from economics honors class of 1982.
Okay.
Okay.
Oh, okay.
Hey, hi, Anjali.
Let's put our ear behind the name. I'm going to do that.
Hi,
makes
Binu.
sense.
So, trivia, Anjali and I used to be neighbors once upon a time.
Hi, Binu.
Hey.
Yenny was
Hi,
my senior
Binu.
by a year. I remember.
Hi,
Yenny very
Pushkala.
well.
Hi, Binu.
Hi.
Hi. I thought I'm a little bit early, but people have joined, so that's nice. I thought I'll be there for the full session, but I suddenly get a message that I might be expecting a visitor anytime. So when they come, I'll have to leave, but I'm really happy to be participating in this. Yeah.
Welcome. It's nice to have you.
Thank you.
Hi, Suki.
Binu, where is this?
Where are you saying, Suki?
Yeah, Suki's.
Oh, there. Asha Mathur is there.
Hello.
Hi, Suki.
Hi guys, I'm in the flight. It just landed, so I'm just going to quickly go back to meetings.
Hi, Suki.
Hi there. Hi guys. Good luck. Good luck. I'm looking forward to the talk.
Yeah, me too. It's been so long we haven't had an ELSA talk, so it's really nice.
I know.
Exciting.
Seriously.
Rosie.
Yeah, Rosie is our
Yes.
I just saw.
person. She
Yeah.
is a runner, no? She came
Yeah,
to
marathon.
Marathon
Bangalore,
runner.
came to Bangalore for the marathon. She came first.
Yes, yes.
Wow.
She's really a rock star.
She's a rock star.
5 minutes on the treadmill and I'm dead running. Running marathon is like, I feel this is like that Greek and Latin to me.
Now you'll teach us financial sprinting. Anna?
Good one, Kitty.
Fluke.
Actually, tortoise is better than sprint.
In that case, the tortoise wins the race.
You know, there's a part of
Rosie
me.
has joined. Sushma. Nice.
Binu, where are you based presently?
Binu's based in Delhi. She's on mute. I will answer on her behalf. Sorry, Binu, we will be we will be excuse me. We will be
Yes, I
stopping
got
in 1 minute.
unmuted. Yes.
Okay, great.
Thank you, Preeti, for answering on my behalf. Anjali, I moved back 3 years ago. So I was here and there. And now we are all here, the whole family.
Okay, so I hope to meet you probably next month. I'll catch up with you.
Look forward. Yes.
I mean, interesting. We've been family friends. My mom and her mom have been very good friends. And then we just, after we got out of college and got married and all of that, we've just not met each other till I'm seeing Binu now. After I think,
Wow.
after I think about how many decades? 4 decades?
4
Yeah,
decades,
4
easily.
decades.
Okinawans live long up, but Anjali, because they have a very good friend circle.
Yes,
That's why they live longest.
nice to hear that.
That's true.
5:05 now. Can I think we should go ahead and start.
I think we should start.
Because I think so. Rosie, can you please mute everybody except for the 4 people that we mentioned at the very beginning?
Yeah, sure. I will. I'll just do that.
Yeah, and then I'll start. Mute. Great. Thanks. Good evening, everyone. I hope you can hear me well because Pushkala. Okay. Good evening, everybody. My name is Preeti Suri, and I am the current president of ELSA. A very, very warm welcome to all of you who have made the time to attend this particular session on financial empowerment today. Before I introduce the moderator to you, I just wanted to say a couple of housekeeping things. Everybody should stay unmuted. If you have questions, please put your name on the chat. Up to you whether you want to put the question on the chat or not. But put your name so that at the end, we are in a position to go to the chat and then invite you to speak up, unmute yourself and speak up. This will allow the talk between Rakhi and Tanya to actually be effective and without any interruptions. With this, what I would like to do is introduce Rakhi to you. I will be introducing Tanya to you. Tanya Prasad is a history major from LSR and an MBA from Narsi Monji Institute in Bombay. And she is also the current ELSA Vice President. She has spent, 29 years in finance and commodities space, working for a host of multinational trading companies, which includes the likes of Cargill as well. And she has managed manufacturing and sales for ArcelorMittal. I think, it's one of the largest companies in the world as well. She has been the first woman steel trader in India and the first one to do a 7-year prepayment and export securitization. So besides the brick and mortar work of sales, finance, and trading, I honestly don't understand how that can be brick and mortar. Sales, finance, and trading is extremely complex. She is also a grassroots leader for her community. She's a prison counselor at Changi Prison, and she's also an advisor for a Jamia halfway house for drug rehab in Singapore. And on top of everything else, as if this was not enough, she's also an avid cook. Over to you, Tanya.
Thanks, Preeti. And now I'm floating. I'm so bloated up now. I'm floating away. No, so just to start, it's I'm Tanya, 1993 history honors, LSR. I tell everybody your subject is of no matter if you put your brain to anything you want to do. This I tell everybody. Let me introduce Rakhi, who I hold in great esteem. She is an amazing woman, an amazing person actually. I wouldn't say woman, she's an amazing person. She's a global citizen, around 22 to 23 years in finance, has managed from a bookshop right up to managing a huge family office. She's done it all. She's an eco major from LSR and then gone on to do her BS in computer science from Michigan Ann Arbor and a master's in finance from Columbia. She's a real, she covers all the bases. Today, she's also, well known in the finance sector in Bombay, in India, pan-India. And she's quite involved in Bombay level as well as pan-India level for investment in finance. And I have to give credit the way she balances. She's very disciplined and she balances everything on a, for women, it's very tough, but it's how you get the balance is what she does beautifully. On a personal front, she's a great DIY person. She's the one who assembles IKEA and Lego. So, because we Indians, we're very bad with hands. Rakhi is really good with her hands and she's really good with Lego. So, Rakhi, to start with, I just wanted to ask you, you're a Prasad, you're from Bihar. Yeah, your finance is very good, education is excellent. That Biharis are taught to study. But in our DNA, we have patriarchy in our DNA. We are raised in a very biased upbringing. So forget finance. How did you get into personal investing? Because that is something women in families in East or even the West or the North are not taught. How did you get into finance?
Yeah, great question. Thanks for having me here. It's a pleasure. Actually, I'm enjoying the fact that, as long as I can see people's faces. So if you're hiding behind your camera, it'll be great if I can see your face. It'll be a more interesting conversation. Thanks for, turning on the cameras. But you're right, Tanya. It's you're not actually, one was never taught how to look at finance when you're growing up. I think in today's world, we're all now trying to teach our children the basics of finance as a skill, right? Like how you teach them how to brush your teeth, teach them also how to, look at the money that they earn, how to save it. That's not something that we were taught at home. But I think my first brush with personal finance, I mean, obviously, after I finished my undergrad education, I joined Goldman Sachs. So from a professional point of view, I was anyways immersed in the financial industry in New York. But my first brush with personal finance was actually to make one of our largest investments in buying a house. So 2 years into my career, I was also, I got married very early. So we had the benefit of, double income. But investing and buying a house just 2 years into one's working life was a huge risk, I would say. But when you're in your 20s, I think that's the time when you need to take risk as well. And that was my first brush with, in personal finance. And obviously, what happens when you buy a place, and you take it on a loan, you're forced to save. So it quite naturally curtails some of our enjoyment and spending, maybe traveling a lot more, but we had to cut down all of that. So cut down on, travel, on spending on clothes, as young 20-year-olds, these are things that you would want to have done. But buying that place forced us to, build our equity in the house by paying off our EMIs. And yeah, so that was the journey of starting investing. And I guess it made us also along the way learn what's important and how to kind of budget yourself. So in the early years of our careers, we were just very, Excel sheets, budget, what's going in, what's going out. So a lot of those conversations also started happening. And I think that's also what made us as a couple as well talk about it as well. So that's how we started learning and investing, dabbling into investing from a personal point of view.
So Rakhi, when I speak to an American and tell them like a sixer or a boundary or a silly point, it's like Latin to them, yeah. But for an Indian, that is like, it's like, क्या बोल रहे हैं, समझ में नहीं आता cricket. That is the approach. So you think finance is as easy, or is just a mental bias that we carry and we just stay away from it? Investment, because you hear words like options, futures, you're like, baap re, kya hai? What is this? How do?
Yeah, you're right. Even today, I won't say I know everything, right? I think what's the beauty of this space is that you can know a little bit and still build your portfolio, if one has to put it that way. So everyone starts with fixed deposits. They start with their pension or their PPFs, or if you're in the US, like 401ks. You start hearing about equity. So these terms, you start learning, but I think the best way to actually learn is to start putting money in those products. Then you understand how it works. So if you want to, people in your own, so, something that really I find quite encouraging now is that more women are getting together and talking about finance, right? We didn't have this group. We're very good at talking about, where we're going on vacation, what we want to wear, what food, what dishes we're cooking tonight, what is the recipe. Why not just add a couple of lines of, how are you investing? What are you investing in? I think because the responsibility all of a sudden shifts to the men to do that, they quite naturally start talking about it amongst their peers. But if we have to, just break down this bias, I think it starts with, just talk to your friends. Well, how are they investing? What are they investing in? Who are they getting advice from? So this is not actually DIY. If you have a doctor to take care of your health, have a financial advisor to take care of your financial health. So you don't have to do it on your own. You can have someone that you trust also advise you on the right way to invest and what are the ways, and that's how you learn. And thankfully, in today's world, now with ChatGPT, you can ask the question, you'll get the answer also. But at least you have ways of getting information today, which wasn't probably there 20, 30 years ago. So I don't think it's a matter of knowing or figuring it out. I think you just need to open your mind to and have conversations around it.
So Rakhi, we earn, so I'll just give an example. We earn 100 rupees a month, yeah? And we pay 30 rupees as tax. We crib, we cry, we try to save, we try to buy insurance. Inflation is 10%. Our 100 rupees in a bank become 90 at the end of the year, and we don't realize. And we still think, oh, 100 ही तो है, FD में 105 हो जाएगा. So how do we, we don't realize what we don't see.
Right.
So how do we start? Because we have to beat inflation. Otherwise, the 100 rupees that we save today in our bank will actually become zero by the time we are 60. And it's worse than getting cancer, actually, if you don't have money in your old age.
No, true. I mean, so in that sense, the way to start is start simple, right? So, and when I mean simple is like, so I'll give you an example. You said 100 rupees, 30 rupees went away. So now you have 70 rupees. Out of 70 rupees, maybe you'll spend 50 rupees on whatever you have to spend for that month. So you have 20 rupees left in the bank. So 20 rupees, how do you split that up? So 10 rupees you must, or 5 rupees you must keep in the bank for emergency. And then the rest out of the 15, to beat that if you had invested in an FD, you would have only gotten 5 rupees or 6 rupees in today's term. Put some money in ETFs. So okay, as a disclaimer, I'm not a financial advisor. I'm not a tax consultant. All my tips are basically based on my own personal investment style. But whenever because I come on the markets and give my view to institutional clients, I do share my views on Bloomberg, for instance. My simple view to anyone who comes to me as a family or a friend, I say, put some money in fixed deposits because that's what you know, and some money in equities in the form of ETFs. It's the lowest cost product. It gives you market returns. When I say market returns, at least 12, 13% over a period of time. So average of the two will make you beat inflation. Is the simplest way to start your investments. Nowadays, I think you can do SIPs as low as 500 rupees per month. And I think SEBI is trying to bring that down even to 250 rupees. But start small, get to know the product, then start putting in more money behind it.
Rakhi, you'll have to tell them you'll have to explain ETF. What is ETF?
Yeah, ETF is an exchange traded fund. Sorry, terminologies come so I'm used to it, but yeah, thanks Tanya for putting that across. It's a way to invest in the stock market through a product which has the lowest commission rate on the market. And it's simple. It's like investing in a mutual fund. So you just, every month you can put in the same amount, which is called a SIP. I'm sure people have heard this mutual fund sahi hai, SIP karo, all of those taglines. So put in that amount of money every month. You can do it through your trading account, any kind of. So the markets have two types of indexes, the Sensex and the Nifty. So you can choose the Nifty ETF, and that's, so if you just note down these terminology and then you can ask someone to help you how to set that up. Yeah.
So how does one start? So like if I know nothing, so how do I start? Do I start by opening an account? Do I start by just asking my banker? How do we start investing? So if I have that 15 rupees, what do I do?
The first question actually you should start is before you take action is what do you want to do? That 15 rupees, what do you want to spend it on? So as women, I think the best, what I've noticed is we do very goal-based investing. Say that, I have kids, my kids are 1 or 2 years old. I have 18 years till they go to college. So I want to build a college fund for them. The second one is maybe I want to buy a house. I want to build some money. I want to invest so that I have enough money to buy that house after 5 years or 10 years. Another could be just I want to build to my retirement fund. So I'm going to retire in 20 years. How do what is the amount that I want to build, have as a nest egg? Or I'm already in that phase where I want to, kind of get some regular income. So how do I invest my kitty so that every month I get some regular income? So whatever is your goal, based on that, then the next step would be to understand how much amount of money you need for that goal. And then after that, you would have to say that, okay, today, this is how much I have. Every month I can put in so much. So then I will know what is the return or the investment amount that I will have to generate to build my kitty. So once you do the backtrack calculation, then you'll know, suppose if I have to earn 10% every year, right? Then I would have to split my 10 rupees in such a way that because debt typically today gives you 6%, equity typically today would give you 12%. If these are the two products that you're looking at, debt meaning like a fixed deposit or equity meaning like an ETF. So the weight, you would have to give equal or slightly more to equity depending on your time period. So that's how you would go through this process. And that's how actually a financial advisor would probably also walk you through this process. So if you're very new to this, it's always good to have someone who has done this before, sit with you and walk you through this process. Don't try to do this as DIY because it's very confusing in the first step, the first time you're doing this. So have someone who knows, who has done it before, sit with you and help you plan. That's how you would think through this. Then you would action on, I have to open up a demat account or a trading account or a bank savings account. Then those would be action oriented steps.
Just to add, there is a story in Indian mythology about compounding. There is this small girl, and the king asks, she saves the king's life, and he asks her, "Tumko kya chahiye?" So she brings a chessboard, and she says on each. So the first chess square, put one dana of chawal, and for every square you double the rice. That's called compounding. So by the time the rice doubles up to the 64th square, it is actually bigger than size of India, the amount of rice. So what happens is we underestimate what can actually happen. So I will again give you another example. If you go in a roulette or a casino, $1 if you put on a bingo machine, the probability of getting $4 is very high. But we leave that and we go to that $1 billion table where the probability is like literally zero. And we put $40 to $50 there. Because that's a long shot we are taking and we are overestimating our probabilities. And here, what is in front of us, we don't do. So life is very simple. Finance and investing is very simple. We think it is very tough. So same way Americans don't understand cricket. We also have been brought up biased as children that, tumko kya samajh aayega? Ask somebody else to do it. So we abdicate our responsibilities. It's actually, and women are amazing investors. We are actually better than men.
Yeah, and there's a lot of, actually as fund managers, women fund managers outperform men fund managers. So this is documented proof. It's also about how much risk women have the capability of taking risk. But just to add to your point, Tanya, on simplicity, we underestimate the value of a 10% compounding over a long period of time and go after, what makes the headlines in terms of, someone made 14 times their investment on a stock in 2 years' time. So you go, wow, someone, built a business and became a unicorn in like less than a year. And some people go, wow, I think we underestimate the effort and the longevity if just consistently and being very disciplined in investing year after year after year, that before you know it, even in a small time frame of 8-10 years, you've built a significant corpus just by being disciplined and consistent. So the mantra is make your life simple, don't overcomplicate it, because between the ranges of return that you can get on different types of products, whether it's buying the investment on the house that you bought, or you invested in equity, or you invested in fixed deposits, or you put it in your provident fund, that range can anywhere be between 5 to 25% annualized every year return. So it's not like you can't make money or a good nest egg by just making your life very simple, but rather than trying to go after the big returns, but focus more on being consistent and every year put in money.
So Rakhi, Yeni I think has to leave early. She wants to know how to start investing to have a comfortable retirement and practical tips as to how to start. What does she need to do? Because she's working for non-profit for her entire life. And she's not, so she wants to understand how to start simple.
Yeah, so the simplest products, make sure you're putting your money in PPF because that's tax-free, right? So take that 1.5 lakhs PPF, put in money in NPS. You have, NPS gives you also ability to earn 10-11% return. So pick up any NPS account. So these are two from a retirement perspective, long-term funds. Then put in some in fixed deposit, that's fine, but you won't get more than 7% return today on any kind of fixed deposit, whether it's 1 year, 3 year, 5 year. Put in ETFs, as I mentioned. So now the way, how do you bifurcate your 100 rupees between these 4 products? That's something that you'll have to see from a longevity point of view. Like, do you have 10 years or 20 years that you have to invest? But at least these 4 products you can start investing and putting money in. Besides the fact, do put in some money, like 5 rupees out of the 100 or 10 rupees in some gold product. Now you can talk about, is your jewelry also considered in that? I would say make it more from a financial gold product, like a gold ETF. So there are gold ETFs in the market, or you can put in money in the sovereign gold bond, which is 5 years. You'll get the appreciation in the gold price as well as 2.5% income every year. So that's how these 5-6 buckets, you should simply put in money to start, and do it every month or do it every quarter, or allocate every year. So during the year, you are some of your savings are going towards all of these 5-6 buckets. That's probably the simplest way to start. Now, how do you invest in some of these products? So as long as you have a bank account and you have a demat account, for the ETFs, you will need a trading account. So these are the 3 types of accounts you will have to invest in these products. And an NPS account for your NPS and a PPF account from your banks. Yeah.
So Suki, I think, is asking about real estate as an investment product.
So the house you live in, if you're buying it, don't consider that as part of your investment portfolio. That's your Chhatra Chaya. You don't want to, I mean, that's what you are, gives you emotional comfort that you have a house to stay in. So don't consider that as your investments. When you're buying a house to stay in, buy it from the purpose that I want to stay here. Is it comfortable for me to stay? Every other real estate that you buy would be considered as part of your investment portfolio. Now, if you find buying a property cumbersome, because you would have to maintain it, you would have to either rent it out, you don't know when you will be able to sell it, and all the calculations you'll have to do, considering tax in and out, capital gains, blah blah blah. There are other ways to have exposure to real estate in the market today, which are called REITs, REITs. You can also invest in these products, which give you two things. One is that it gives you easy liquidity. So suppose today you said, I need to sell my real estate portfolio. Instead of going and finding a broker to sell that property, you can just sell your REIT on the exchange itself, and within a couple of days you will get that money. So that's what I mean by liquidity. And second is, you're not exposed to one property in a REIT. In a REIT, it gets spread across many properties. So in a situation where you bought a real estate property, but that property did not appreciate because that area did not develop well, you may have lost out on returns or gains that you would have made on that property because you took a chance on one property. In a REIT, you get exposure to many properties, which also diversifies your risk in that sense. So these are two very simple ways to have exposure to real estate, but through a different product.
So, is REIT better than actually buying property, Rakhi? So again, I'll use that example of bingo machine and $1 billion in lottery.
See, it's like the same question you'll have, do I buy gold jewelry or do I buy gold ETF, right? So it's the same asset class, but the way you're investing is through different means. And as I explained, real estate, buying a property, unless you really enjoy hunting and finding and renting it out, I have, over the years, I've actually, so this is again from personal anecdotes. The only way we knew how to invest, because you know how our Bihari parents would always say, invest in property, right? So we bought our first place in Manhattan. When we sold it, when we came back to India, we bought another place, though we never lived in that other place. So that was how we built our investment portfolio, by buying and selling property. But by the end of it, after doing 2 or 3 of these kinds of transactions, I got really frustrated. And I said, this is a headache. It's very difficult to, find the right time to sell it, find a broker, maintain it, blah, blah, blah. So instead, invest in other products, which are easier to buy and sell. So at the click of a button. So if you want it to be non-headache, invest in REIT is what I would say if you want the real estate exposure.
I would just like to add to Rakhi, property is very liquid. So if you need money tomorrow, all of a sudden, and you have a 100 crore house, Bhagwan bachaye, usko bechne mein 6-8 mahina lag jayega. So, and the other thing is rental return on property is very low in India. It's 2%. So you may be looking at capital appreciation on property, but the rental return is zilch. Actually, you end up paying more on maintenance of the house than actually getting rental out of it. And then the tenant will come, junk your house, so it looks, so as Indians, we have been taught property kharido or gold kharido. But they don't tell us what headaches come with it. Like gold ka matlab jewelry with jadao, and so we should go to sell it, you get zilch again. So one misnomer women have, gold mein invest kar diya. Stree dhan bahut hai. Bech ke dikhao. अभी वो आप 22 कैरेट बोलेगा, वो बोलेगा it's 14 carats. You will get nothing out of it. So it's a miss. So Rakhi, you think jewelry and bags are not investment criteria? People do invest in bags overseas, but bags,
no, not saying that. Please buy your jewelry. Please buy your bags. India is a consumption economy. Until we go out and buy and shop, other people will not earn income. So please go ahead and do all of that. But be mindful. Don't consider that as investment or building your nest egg or your financial. It's nice to wear a nice piece of jewelry and you feel nice about it. So please shop for it. But don't think that, I'm buying this jewelry because, I'll use it for my daughter or my son's wedding. right? It's probably, you might be emotional about it. You probably don't want to exchange it. You probably don't want to give it out, give it away. So buy what you want for your own self. But if you want to buy jewelry during your children's marriage time, why don't you just buy the gold ETF, sell it at that time, and buy the jewelry with that money that you have invested in the gold ETF? Because the designs will be different 20 years from now, 15 years from now, when your children are getting married. So why go through that old rigmarole of, giving your jewelry to exchange for something else?
So Rakhi, I think Smita wants to know about financial stability of the markets. She's talking of 2009, COVID. So the crashes.
Yeah, you're right. And that's exactly why you should be very diligent about how much money you invest in which product. So again, from my personal portfolio, I actually didn't start investing seriously, building a portfolio or thinking of a portfolio till 2016. That's basically 8 years ago. My investments till that stage were all a little bit ad hoc or very goal based, saying that, oh, my kids are now 1 year old, I should build a, their education fund, or we're buying a property so that we can, have a little bit more when we sell it for our retirement fund. I actually started building a financial portfolio from 2016. And the way I went about it was investing across different in equity itself, which kind of funds. But because I was a fund manager, I had the insights of, which stocks to buy. But I wouldn't recommend that as first-time investors. Once you get a little bit familiar with the markets, then you can dabble into stocks. But the stocks, the funds, the mutual funds that you bought, the ETFs that I bought into, and then on the debt side, as I said, PPFs, NPS, fixed deposits, these are all great debt products. Besides, if you want to invest in debt mutual funds itself. So across these 5-6 different products, that's how I built my portfolio. And also then on a quarterly basis, so when I built my portfolio, I said that, okay, I want only exposure of 40% towards equity, 60% towards debt. We're very conservative, right? And this is, usually it would probably be the other way around, but we did it that way just because we wanted to be a little bit conservative, and we're more focused on preserving and building rather than sprinting. So it was more from a marathon perspective, right? Because of that weight of 40% in debt and 60% in equity, during COVID, when the equity markets fell by 30%, it would have impacted our portfolio a lot. But because of this, bifurcation, our portfolio only fell 3%, meaning that we were saved because of the cushion that we had with 60% in various debt products. So in that sense, the way you allocate is how you can alleviate some of the concerns of the financial markets. Now, financial markets are always going to go up and down. And the thing is, you can see it every day, right? Unlike in a real estate, when you buy a property, you don't see the price of the property going up and down every day. You only know the price anecdotally or when you go out and sell it. In the equity market, you're seeing the ticker and the price of the Sensex or the Nifty every day. So you can get heart attacks every day if your market is falling, right? So in that sense, the best advice, once you've allocated and invested in it, don't see it until you really need to see it. And I'll tell you why it works. Because of the fact that if you have done a good job at day one in terms of which types of investments you should do, you should let it compound on its own and wait for 5 years, wait for 7 years, and then then you'll realize the amount it has compounded and gained. Besides the fact that, I think once a year, you should just take a stock of it. Anyways, you have to, because you will have to file your returns and you'll have to fill up all those details in terms of where you've invested. But from that point of view, once a year do a check, but otherwise just continue your discipline of investing in those products.
So how do you think land is a good, you think land is a good investment in India?
I'm not a land expert. I've never invested in land. It's like there are probably thousands of financial products out there, even non-financial products. I would just suggest focus on the things that you know and you know well, and invest in that. If you're a land expert, please go ahead and invest in it. But I've never dabbled in land, so I don't have any good advice around that.
So one thing I would like to, add to what Rakhi is saying, do what you understand. If somebody tells you buy yen or buy euro and you do not understand what the person is saying, do not do it.
Yeah.
If you want to do it, go read up. Internet, Chat GPT, Gemini AI, everything is there. Read up. But do not do what you do not understand. So that's the first basic of investment. So if you understand PPF, if you understand ETF, if exchange traded product, if you understand mutual fund, do that. If next step, if you learn, do something else. But as a woman, I would advise, don't do what you don't understand. I am a commodities trader. I do not trade what I do not understand, because that's a recipe for disaster. Somebody will come and tell you, come and buy this, you will get 5x. That's the first sign that you shouldn't do it. You know how the sabji wala or the, when we were younger, those tokri leke humko bechne aate the kuch saman ghar pe. Are, isse ye ho jayega. And then, those knitting machines and sewing machines used to come and teach him, isse ye banega. And then after he went off, he didn't know how to use it. Those Chinese pins and all that. So it's the same story. What you do not understand, do not buy.
Yeah, absolutely. You're right. There's that one question about how much should we put in, should we put more in equity versus debt in younger years and reverse as we age? Conceptually, yes. But so I'll give you an example of, so I was building a education fund to fund my children's college education. So it was over a 15-year period. In the first 13 and a half or 14 years, it was more toward, it was equity, all equity. Then in the last 1.5 years, I shifted it over to debt. So when you come closer to your goal, shift the money from equity to debt, because then you know that that much money is assured that I will get once for the purpose that I need it. So the shifting from equity to debt does not only have to be from an age perspective, but it also could be if you are investing in for a certain goal. So as you get closer to your goal from a time period, move it from equity to debt. But you can use the initial years to benefit from the higher returns that equity gives you.
So I think, Rakhi, somebody's also asked about ULIP versus, mutual funds. Oh,
So I think there used to be a taxation benefit with ULIPs versus mutual funds earlier, which I believe has now gone away, right? So from a taxation, so you have to look at the ULIP conceptually means that you are not only investing in some kind of fund, but also you are getting insurance. Now, the best way to cover yourself from an insurance point of view is to take a term insurance. And then, so if you had 100 rupees that you wanted to put in the ULIP, and the insurance coverage you're getting was for 25 lakhs, for instance, instead, spend maybe 20 rupees on buying the 25 lakh term insurance, and the 80 rupees you put in a mutual fund. And that will make, again, your life simple, because you have the insurance, you know how much you would get covered if you, term insurance is always if you die, right? Your next of kin will get that amount. But the amount that you're investing will be focused more towards growing that kitty of what you want to invest it in. So I have been very hesitant to anyone who asks me this question to invest in ULIPs, because I don't find the combination of insurance and investment really worth it. If there used to be a tax advantage, which I don't think is there anymore, so that also goes away from the advantage point of view. So I would simply say put it in term insurance and put it in mutual funds separately.
Okay. How do we assess risk? Because, you know, if you see this chat group, Rakhi, I think we're much all, I think, going towards retirement, more going towards there. We're not 20s. So how do we assess risk and how do we manage risk of our money? Because, you know, we are coming close to retirement and we all need to preserve for, you know, a monthly expenses for the next, with longevity going up, maybe next 30, 40 years. How do you never know?
Yeah, I mean, okay, so typically people say plan till your 80s, then the balance 10 years, if you go to your 90s, we all hope for good health. So if you are in your 40s or 50s right now, you do have 40 to 50 more years, right? So from that point of view, it is a long period of time. Now, but the difference is that you may not have earning income to add to supplemental your retirement funds. You have a kitty which you have to make it grow to make you survive through those 40, 50 years. In that scenario, again, look at what you have as a corpus. How much is going to be your monthly expense if you don't have any earning income coming in? And see whether that corpus, if you but you have to also consider inflation. So for instance, if today you spend 2 lakhs per month on your household, right? Next year you have to consider that, you know, 8-10% inflation. So it'll be 2 lakhs 10,000 rupees, or 2 lakhs 20,000 rupees will be your expense next year. So like this, every year your expenses will go up, even though you have only that 2 lakh worth of expense. So you have to consider that also when you are thinking of how much will you be spending over the next 40 years. Then see, do you have enough money today to have it invested over a 40-year period to give you that income every year? So think of it like this. Suppose you had 100 rupees and you put it in a fixed deposit and you get 7 rupees every year, because that's the income you can get every year without it compounding, right? Because you need that 7 rupees every year to spend. Is that 7 rupees enough? Or do you need to have 10 rupees? Then that means that you cannot keep 100 rupees all in fixed deposit. You'll have to put in, 40 rupees in equity and 60 rupees in debt. But be mindful, somewhere you'll have to balance it out. You don't want to put all your 100 rupees in equity at your retirement, because of the fact that equity is very volatile. It is not consistently going to give you every year the same amount of money, right? So it's prudent to either then decide that, do I need to cut down my expense, or how can I maximize my kitty without making it exposed to too much risk? So when you are using your nest egg, be very careful in terms of not overexposing it to equity, because you don't want to lose money if you need it in a particular year.
Rakhi, some people are also asking about Bitcoin.
So this comes at a stage when you have fun money. Like how when we are young, we have fun money, we can spend on clothes, we can spend on, shoes. If you have fun money in your investment kitty, which is like, out of my 100 rupees that I've invested, if I lose 10 rupees, so it's like if I go to the casino and I lose 10 rupees, it won't impact me. That's what I call as fun money. So if you have that fun money from the investment kitty of 10 rupees, you can explore all of these new products that are out there like Bitcoin and NFTs. I would not recommend it as part of your core building your portfolio.
Yeah, it's like having, trying caviar when you're vegetarian. It's something like that. It's so you have to, graduate to that
Dharam
level.
brushed ho jayega. That's dharam brushed.
So you have to go slowly, slow and steady. So, there are lots of products. So like somebody will say options kariye, futures kariye, but do that only when you get a hang of it, when you understand it. You're in it daily. If you're not doing it daily,
Remember, option trading as an individual, you are competing with institutions that have high, financial models, so much computing power to do option trading. You're working against a large machines in that sense, right? So be very careful and mindful. Again, I would option trading and all, please put that in your fun money bucket if I had to put it in any other way.
So, Rakhi, on investment, okay, I'm 52. Should we get, how much should we gamble? Okay, the fun money. Like how much do you think one should gamble out of the portfolio? If I have a 100 rupee portfolio, is it worth gambling?
As I said, suppose your 100 rupees, 70 rupees, it will make you survive for the next 50 years. You have 30 rupees, which is you can spread it across a little bit higher risk products, as they say, right? So, but you will have to decide on your own. I mean, this is a very personal, what is my kitty? How much do I need to survive for 50 years? What is the balance that I have? Then only from that balance, because the thing with fun money is it's only fun until it lasts, right? The moment it disappears, it's all unhappiness. So as long as that unhappiness doesn't make you, go on the street, then it won't bother you. It won't stress you.
Another point that I had, Rakhi, on this investments, we women are very emotional. IQ may be very high, but we still have loads of EQ. Yeah. So like we get like a mutual fund. I know the managing director of the mutual fund. I do not like his face. Now, what do we do? Or the equity. I know the head of sales India and I hate him from the bottom of my heart. How to overcome that and invest? So, I have that problem, big problem. My actually broker tells me, "Aapko shaadi nahi karni hai usse." I said, "नहीं, करना ही नहीं. I don't like the person's face." So how do we women have that big problem? We are emotional investors in that sense. How do we overcome that?
Just look at the numbers. Be very unemotional about it. Look at the stats. What is the, as I say, past performance doesn't reflect future. But if you go to a financial advisor, for instance, and they suggest these 5 mutual funds and you ask him why, he will tell you, oh, these are his rolling returns. These are, he's been doing a good job. His returns are improving. Or, this fund manager has been in the business for 20 years. He knows his stuff. So he will give you more qualitative. So if you feel like you're being emotional, maybe just bounce it off with your advisor that are these funds doing well or not doing well. Again, be careful of who you're taking advice from. Remember, financial advisors, if you are not paying them, they're being paid by the funds. Okay. So they have it in their interest to sell you those funds where their commission is higher. So be mindful. That's why sometimes they push more ULIPs because the commissions on ULIPs are higher. Yep. So it's always good. Either you have one fund advisor who you pay as a advisor fee. And so they give you only those funds and where you invest directly into the mutual fund. So he is not being paid commission from the mutual fund. I know Indians don't like paying fees, but if you want right advice, it's better to pay the advisor some fee and not him getting paid by the fund manager.
I'll just give an example. My fund manager advised me by Raymond. Usi samay that Vijay Singhania marriage issue started. I knew Nawaz. She used to be my aerobics instructor. I said, no chance. I will not put money in Raymond. And it was a wrong call on my behalf, but it was an emotional call. So I'm just giving you an example. So we women can be a little more. So I don't know how to overcome it, but it's just it was a wrong this approach from my side. But it's very tough for women to overcome it. It's just sharing so that when it comes to you, you realize the mistake you're doing. I did a big mistake, so.
No, we all do mistakes across time periods, but unless you make a mistake, how do you learn, right?
Yeah.
So, but hopefully you don't make a mistake that impacts your whole life. You
No.
make small incremental mistakes. So when you are experimenting, experiment small. Once you get comfortable, then start allocating more money towards that. So that's why I said it's always good to start small with a certain product. Once you get very familiar about how it works, then you can start allocating more money towards that product. Yeah.
And I agree with Rakhi to pay the advice. If you pay peanuts, you get monkeys. So better pay upfront so he doesn't overcharge you. I'll just give you an example. I know somebody who sold, I think, a 50 crore insurance ULIP to somebody. She made 2 crores. She pushed a product to the person he didn't need. So, that's overselling, or like selling something like insurance linked to like a 75-year-old. Again, it's wrong sales. So you have to be very careful of these traps when you are. So you have to hear the advisor, but you have to also use your brains. You have common sense, not brain. It's common sense. We all women have common sense. We are very good at bargains. So we catch that. If you talk to 5 advisors, you will catch it. You will catch that in their voice. We are very good at it.
But again, again, it's the same way, na? We all test, like, is that tailor good or not by asking 4 of our other friends, right? The same thing is ask if some financial advisor is giving you advice, bounce it off people who have no interest in giving advice, but have they heard about the product? Are they aware of it? So bounce it off with a few other friends that that are also equally in tune. So I would say make a group of, is always good to bounce off ideas with other people who might be also investing, but have no interest or don't make money out of advising, right? So at least you get a sense of what is their experience. So have a little peer network, 3-4 friends who actively invest together, bounce off ideas. It's always good to share your knowledge.
So do you think when we women have book clubs, we should also have investment clubs, meet together, discuss?
Yeah, why not? Why not?
Like gossip about some people and then get to investment instead of books.
You can gossip about investments also. It's kind of uncanny, but I also will tell you this. So since anyways I'm part of a professional investment network, we are a group of 150 women investment professionals here in Mumbai. We call ourselves WIN, Women Investment Network, and we're all career professionals in the investment space. But when we meet on the context of a book club, we actually talk a lot about, gossip about the mutual fund industry, etc., etc. So in a way, you kind of you find an interest that brings you together, but we do talk about, other parts of finance that help us in personal or connections or, professionally, if we need any advice. But I think it's great to have, a little 3-4 people group who you can trust and share some of these conversations with.
So how does an ELSA win sound?
ELSA win. We can all win together, right?
Any good app to learn basic nomenclature, or any book to read?
Just get the book by dummies, right? Financial investing for dummies or something like that. Honestly, it's as a professional life, there are so many ways to, so many books that one has read along the way. But the simplest advice or apps, a lot of these new fintech apps are there trying to, educate people, help people. And there's a plethora of them. Now, I personally have not used any of the fintech apps. It's just because I've learned professionally. So after talking to many family office heads, for instance, we've all come to the conclusion that Excel is the best way to track your investments. And it's surprising. And these are family offices that may be managing, thousands and 5,000 crores worth of investments. And they also say the same thing. And I'm like, okay, so after all this evolution in the technology world, we are still depending on Excel to manage our, track our investments. But to learn, I think the internet is great. At least go to the basic, finance.yahoo.com or, the well-known websites, investing.com, and learn your basics. But when you come to execution, have a buddy with you to kind of guide you and work you through it, especially if you're doing this for the first time. Don't do it on your own. This is not a DIY. I would suggest. It's always good to have someone alongside you to help you set up things.
And I think gossiping investment is actually a good idea.
Yeah.
No, because we there is a lot to learn. We underrate gossip. There's a lot to learn from. If you chafe there are a lot of grains of wisdom in that gossip sometimes when you sit. So we spend way too much time on talking this and that, but I see men do it all the time. So I work in an industry where there are literally no men, no women. So I sit there like a dumb idiot, and I see men do this amazing information gossip on markets and people and what are they doing, what are they buying. The whole network is so clued on. And if even it's just plug and play. So if you can plug with one of those, okay, it's not easy, but if it helps a lot. It really helps a lot.
So,
and it is really easy.
Yeah, one book I would recommend, which I've recently read, which I feel is awesome, is The Psychology of Money by Morgan Housel. I'll probably put it on the chat. It's a great a book to think about how to look at investing and how to look at the concept of money, right? So I think people overrate money as the only thing in life, but it's a great book, I would suggest, and I'm just typing it, so that's why I'm.
So I think I would like to add one thing. The first billion that Warren Buffett made was at 60. First billion. Uske pehle he was like literally kuch nahi tha uske paas. So don't make age a factor, and don't age is not a factor in this. And he actually made his major money in which he is in that big league after 80.
Yeah, well, that's the power of compounding, literally. I mean, you make $1 billion, and if you in 7 years that'll become 2 billion if it just compounds at 10%, right? So but I'll caveat that by saying he started investing at the age of 11.
Yeah.
So 11 to 50, what he took to make that billion was actually 40 years of hard work to get to that billion. So it is a lot about being patient, being in the game. So as they said, it's not about market timing, it's more about the time in the markets.
And also, if you see market crashing, it is a blip. Never panic and sell. Am I correct or am I wrong?
You're absolutely right. In fact, every time the market crashes, you should double down. So it's the psychology around it just seems the opposite, but that comes from the conviction that the markets will rise over a long period of time. So even though it might go up and down, but the trajectory will be up and down over going up towards an upward sig. Now, again, a caveat. Japan stock market peaked in 1989. Only last year did it cross that peak of 1989. So for more than 30 years, it was actually the markets went down and then slowly started coming back up. Why? So from a 10-year point of view, my view on India is our stock markets will go up over the 10-year period just by the sheer energy, enthusiasm, entrepreneurship that India sees. Forget about the election point of view. Elections always probably will give you an opportunity to invest because it's an event. So don't confuse event versus your timing in the market. So from a economic point of view, India has, at least for the next decade, and this is maybe a very consensus view, that there is a lot that India can deliver in the next 10 years. It might deliver it slower if A government comes, it might deliver it faster if B government comes, but it will deliver something over the next 10 years for sure. Unlike a situation where one feels that, you know, it will stagnate for 30 years. So I don't think that's the view that people have in the institutional investment world about India. So when you're looking from a 10-year perspective, equity still should give you that 12-13% return from an Indian stock market perspective.
And I would just like to add to what Rakhi is saying, because the market is growing. It's still in its the nascent phases. So now today, what Sensex is 77,000. Nifty is 21, 22. I think it will go much further. So just by even if you don't buy a stock, you just buy the Nifty ETF or the NSE product. Just benchmark against the Nifty or the Sensex. You will make enough money. You don't have to, look at exotic stuff कि ये करेंगे तो ऐसा होगा, इसको 4 बार leverage करेंगे, वो सब बहुत पागलों के लिए, हमारे लिए नहीं है, हमारे लिए बहुत basic है. We are looking at 10 years of growth in India. And even if you get a 12% compounding on your investment, your retirement is taken care of actually.
Yeah, I mean, considering whatever you put as a kitty towards that.
Yeah. And you'll get all these Excel sheets online. ChatGPT is a godsend. Okay, it also take away all our jobs, but it's a godsend in that sense.
No, it'll make us more efficient to do other things, right?
Yeah.
But
yeah. And I'm a commodities trader. Yeah, so our markets swing crazily. So it's not like equity. So if you're regularly in the market, you will never lose. But if you think you'll buy cheapest and sell highest, you will be the first person to lose. So you have to be regular. So like how we
that's
get
why
up in
they
the morning.
say, put a SIP. So because no one can time the market, even great fund managers don't know the low of the market. You cannot predict it. So just say that every month, on the first of the month, irrespective of where the market is, I'm going to put in that 1,000 rupees, 10,000 rupees, 1 lakh in those funds and just make it automated. Do not, and what happens is after a year, when you look at it, you will see that it is given an extra gain. You'll be happy about it. Shut the Excel sheet. Continue, the monthly investment. So that's the way to do it.
You have to be regular.
Yeah.
Like it's like discipline. It's like you get up every morning, brush your teeth, have a bath. You have to do it like that. You cannot. So if the market does dip, double down. Whether go in that day, you make an effort to go in and buy.
Yeah, extra. Then you put
extra. But what is going on? Just keep on doing it.
Yeah. So yeah. So that's the. I don't. Yeah. Oh, I don't know. Are we have more questions, right? Or.
Do we have any more? Can we open the session to everybody to talk? Where's our admin?
Rosie, can you unmute everybody,
Yeah,
please?
I am here. Yes. So whoever wants to speak, they can unmute themselves now.
Can I go first?
Okay, I just want to add, when you said SIP, if you have more than one SIP, this is just from personal experience I'd like to share with all of us, that it's good to have one on the 1st, one on the 7th, one on the 20th, and so on and so forth, so that since we can't time the market, at least your SIP is then taking care of the dips and the ups in the market, so that you're better off. Anyone having more than SIP in more than one fund.
Yeah.
Palak?
Hi, everyone. Great session. I just have one question, which I've been kind of wondering for a while, which is we talk about emergency funds and having like a good kitty set up, like a separate emergency reserve. The one thing I can't figure out is where do you park that money? Because it's a substantial amount of money we are talking about. If we say it should be 6 to 9 months of expenses, and if somebody's expenses even just 1 lakh, we're talking about 6 to 9 lakhs. And that money sitting in the bank, again, is not such a great idea.
Put
And
it in
I
a
know
liquid fund.
US has that HYSA, right? The high yield savings account concept, which we don't have in India. What's your recommendation? Where do we put that money?
Put it in a liquid debt mutual fund. So, for instance, your saving account in India will probably give you 3.5 or 4%, depending on which bank or whatever. The liquid fund over a 6 or 9 month period could probably give you 5% or 6%. But the advantage is that you move that money to the debt liquid fund. There is no risk of it, actually. The ultra short liquid fund, right? Which is in a 1 day, 2 day paper at the back end. But the advantage is from a tax perspective also, that you are not see, you're not putting it in a fixed deposit, right? Because it gets blocked, right? 6 months. But here, at least you're putting it in a fund that is supposed tomorrow. The whole point of emergency is you need the money tomorrow, for instance. So instead of breaking that FD, you can just redeem the money from the liquid fund and have access to that. So you earn probably 1 or 2, 1.5% more extra return than your savings account. But so that's the advantage around that.
Okay. And no pre-withdrawal penalties usually associated with this.
No, there are no pre-withdrawal, and the tax would be on the amount, whatever you redeem and whenever you redeem. So it's not like in FDs, what happens is if you put it in a 3-year FD, every year you have accrued interest concept where you're paying the tax even though you haven't received that money yet from the FD when it matures. In the liquid fund, what happens is that you only pay the tax once you sell or redeem that amount from the liquid fund. So there's a difference. So you're not actually having to pay the tax upfront in your return. Suppose you kept it in the emergency fund for 1.5 years, right? So you would only pay the tax at the time of when you're selling that fund and not in between when you have to file your return.
But also to clarify, that tax is only on the gains that you have, not on the principal. That's just that part that you've got an extra.
Which is even with the FD as well, which would have been on the interest amount only. Yeah.
So Rakhi, you mean to say this liquid fund is the savings fund, is it, of the mutual fund? From where they keep
So
moving?
mutual funds have debt funds, and in debt funds, they have many types of debt funds. So you can ask for a ultra short liquid fund. That's the terminology for that type of.
Yes, so if you go into your Demat account, you go into your mutual fund or Demat trading account, you can do a liquid fund search and you'll get all the names.
Got it.
Sometimes they are for 3 months also, the liquid funds. You can put your money for 3 months as well.
Smita?
What about the
Shall I go
flexi
next? Yeah.
fixed deposits?
Yeah, Smita.
The flexi fixed
Okay.
deposits,
So-
because those, that whatever money you have, you can just put it there, even if it's, as and when you need it, you can take it out, and they don't really have any charges for taking out the money prior to a term, and it also earns you a higher interest rate. What about those?
Yeah, so I mean, there are many products which can be comparable. It's just whatever you're comfortable with. Just see the interest rates. I mean, are you getting 4% or you're getting 4.5%? You can just compare it. But as I said, like even in my debt portfolio, I have some in fixed deposits. I have some in, my liquid funds. I have some in different other types of debt funds. So it's absolutely fine as long as you know what is the rate you're getting. And it's flexible. You're not penalized for withdrawing early. Yeah.
Thanks so much, both Rakhi and Tanya. That was lovely. I have to leave, so just want to thank everyone.
We have an ELSA investing group. So if you want to join, you can join that as well. So if you have any question, we can just, anybody who's in part of that group can answer.
Okay. Thanks so much.
Yeah, Smita.
Okay, so my question, Rakhi, I already put it in the chat also, is about ethical investing. Are there people who are looking at ethics, ethical people? Like I'm now, very, very worried for several years of investing in people whose, financial returns may be high, but we don't actually respect the entrepreneurs or for their business tactics. So are there companies or investment managers who actually help with doing that kind of investing? That.
So this whole concept of ESG is
Mhm.
something where funds have been trying to educate investors that they are going to be investing in companies that have high environmental standards, social standards, or governance standards. That's why E, S, and G,
Yes.
right? So ESG type of funds typically would, the fund managers would look at it, look at the companies from that lens as well, which is some way a little bit from the ethical point of view, right? When you're talking about high governance standards, that they're not doing something that would be at risk, right? Now, the problem is that ESG was picking up a lot, but there is, how the concept of greenwashing, where you are saying that you are having high environmental standards, but you are doing it just on paper and it's not really reflecting. So so ESG washing in a way is also happening. So you get caught up with, why would ITC be part of an ESG fund? Its major business deals in cigarettes, but it does a lot of other social good and whatever. So they label it as an ESG compliant company. Now that in my mind would be across.
Or Vedanta or Reliance, I don't invest in these companies at all.
Yeah, unfortunately,
Returns.
the index or the ETF for the Indian market will have Reliance because it is such a huge market cap company. So when it comes to investing, if you have very strict norms from an investment point of view, then you would have to go buy each stock and start looking at it
By myself,
yeah. I don't think any of the ESG funds in India still do justice to the term of ESG yet. Even globally also, it is a little bit of a sham right now. But the consciousness is actually there, and I'll tell you why it's coming to this point, at least from an environment point of view. It's not because people need to, Mother Nature, this, that. It's more from the point of view that, businesses will be at risk if there is more flooding, if the heat wave is there. So it's a little bit of a dichotomy, but I think people are focusing more on this factor that, they have to be, the companies need to do more from the environment point of view, be more water recyclable, net zero, things like that. So I think SEBI is also pushing companies to actually start listing out what all they're doing from an ESG perspective. So as companies are forced to disclose, they will start also acting. So at least there is hope. Right now, it may not be in the true form that we may want it to be, but there is hope that there is a direction that it's going towards that.
Okay, thank you.
Kirti?
Thank you, Rakhi. I enjoyed hearing your views on the ESG part of it because it kind of interests me as well. So just a little change of tack. Just wanted to ask, when people are talking about FDs on which the returns are not exactly very high, why is it that financial advisors never talk about post office schemes? I'm just so curious. Is it because they are not marketed?
Again, as I said, advisors, I don't know if they get commission from the post office scheme.
No, right.
I mean, I think now the commissions have gone down. So I always feel that just because, agents don't get a return, they never recommend post office schemes, even though the return might be much more than a bank FD. You know,
I
I
think
mean,
there
I
are limits
understand they're not
also.
computerized and they're not as sophisticated as, walking into a bank.
Right.
But even so, is
So-
that it, or is there something more to it?
No, there's nothing more to it, but I think there's also a limit to how much per person you can invest in this scheme. So a lot of these,
Not to my understanding. I mean, they have something called a term deposit. You could deposit any amount.
yeah, and the ease, right? So how easy is it to open the account, to service the account?
It is as easy as sitting at your dining table. The agent will come, fill up your form, and that's it. That's all you have to do.
The right thing you said, agent.
Agent.
So as long as you have an
Yeah,
agent,
but then you're not losing anything. No? The agent will do it if you want it.
So the same thing with ETFs. No advisor will tell you to invest in an ETF because they don't get commission, right?
That's what. So I think this is a very important part of investing where people have to make their own judgments, that a lot of the recommendations are on the basis of what the agent is earning.
Correct. Correct. So which is why I said that if you find an advisor that actually takes money from you because you are paying them for advice, they will then advise you on those products which you will give you maximum return and the least commission.
So isn't the way the market works that such advisors are usually these new app-based people? Because the traditional agent always gets the commission, isn't it?
Yeah, no, but now you have independent financial advisors. They're called IFAs. Because with SEBI, you have to declare yourself either as a IFA or a mutual fund distributor. You cannot be both at the same time. Some companies kind of make it a little bit wishy-washy by saying that this division of mine only gives advice, this division of mine does mutual fund distribution. But as a client, whenever you're signing up with the company also, you have to declare whether you are taking advice from them or they are going to be a distributor of products to you. So be mindful of this. I know we don't like paying fees, but the point is, if you are not paying the fee, the advisor is, the distributor is anyways getting fees from the commission that he earns from the product, right? So it may seem free to you, but it's not free in reality. You are paying for it because let me explain this simply. You bought something for 100 rupees. The fee of that product was 2 rupees, right? The fee of the product was 2 rupees. 1 rupee went to the your financial advisor, but if you have, and 1 rupee goes to the fund house. Okay. Now, if you bought that product 100 rupees directly from the fund house, you would have only paid 1 rupee. That 99 rupees of yours out of the 100 would have compounded and given you more return versus 98 rupees that you would have compounded and given you return. So in a way, it's better if you give a fixed fee to your advisors.
Yeah.
I am paying you, 1 lakh rupee a year, but give me sure my performance, my kitty goes from 100 rupees to 110 rupees at the end of the year. So you actually make your advisor work hard to ensure you get better returns. He will give you the right advice on the right products to invest in, even the low commission products.
So that's very helpful to know. So is it that my existing advisor, for example, recommends a switching between mutual funds? There might be a self-interest there, isn't it? Thank you.
Yeah, Pala.
Just a very revealing discussion, right? Like how everything is driven by commissions ultimately at the end of the day. Just one sec, sorry, my toddler is here.
Like they say in that movie, no greed is good.
No, they say your data is, you may be having your social media accounts for free, like WhatsApp, but all that data or all that personal data is actually what is being used by the companies.
There's nothing free, right? Like they say, if something is free, you are the product. You are paying that with your data.
Yes, you got it.
I know we are at overtime, but just one final question with this this whole concept of FIRE, right? Like the financial independence, retire early. There's a general rule of thumb that it's supposed to be 25 times your annual expenses. I've been trying to do a lot of research into whether this is correct for India. And there seems to be like, and I've drawn my own models, it makes sense, but it's also when you have to tell somebody how to estimate the retirement kitty, what is a good amount to tell them? Is it 25 times annual expenses? Or for the Indian context, 30 times, 35 times? There's a lot of variation and a lot of opinions. I'm not sure I found the right answer for that.
I think
First you
the way
make your
I
age.
sorry, huh?
Sorry, first you make your age 100, then you work back.
So I took expectancy as 90, life expectancy. By the time I reach there, I think life expectancy will keep increasing.
So, okay, the 25 times means that 90 minus 25 is the simple maths you're doing, right? That you have, if I had to just divide that kitty into 25 years simply, right? Without taking into account the inflation part, etc., etc. So literally you're then saying that at the age of 65 is when you will retire, right? You have to have that kitty by 65. The other way to look at it is put a figure to it, right? An absolute amount. Say that, I want to have 10 crores by the age of 50, right? Suppose you're 30 and you say, I want to have 10 crores. Then you work towards that. Then at the age of 50, you say that, oh, 10 crores is not enough. I want to have, 20. And sabke desires and wants also change with time. Like, I may have been satisfied with a 1-bedroom house when I was in my 20s, but when I'm in my 30s, I might need a 2-bedroom house or a 3-bedroom house. So I need to spend more. So I always feel like it's good to have a target in mind and then work towards it and then reevaluate the target after 10 years. And because by then you would have some significant kitty to then say that, oh, now I can play with this kitty to see how much I need to invest towards my next target. So even when you are in retirement age, right, that you're not having earning income, like from your salary or something like that, you'll have income through other sources like rental, through your investments and etc. But having a 10-year goal kind of keeps you engaged with what you need to do for the next 10-15 years. I mean, also consider that, planning for 25, 30 years, we don't know where the world is going to be, where we are going to be, whether we'll be alive or not. So sometimes, having too long a horizon sometimes kills the whole journey of making, the 10-year steps. Sometimes it's easier to break it down.
That's a great point. We've not considered lifestyle inflation, not even general inflation. Yeah.
Right.
Thank you.
Lifestyle inflation, and we reboot every 5 to 10 years ourselves as people.
Yeah.
Forget markets and we change. What we were at 20, we were not that at 30, we're not that at 40. So our aspirations, our hopes, everything changes. We could have lived in a Barsati as a child, as young, and now we refuse to even live below a 5-star hotel. So it's a big difference.
Yeah.
And to downgrade yourself is really painful. Very, very painful. Upgrade is easy, downgrade is very tough.
Very true.
Not really. You might wish to stay in a 1-bedroom house after you've stayed in a 5-bedroom one. It's possible.
Yeah, but
At
that's your
60.
desires have changed. So then that kitty that you may have built on, expenses for a 5-bed, all of a sudden seem like a lot now because you're in a 1-bed. So, I always feel like don't overextend and plan for too long. Break it down, because all our wants and desires, and we have to live also now. We can't always save for 20
Yeah,
years later.
actually.
Thank you, Rakhi, Ashima. Thank you, Tanya. Ashima, over to you.
Ashima,
you're mute.
Okay, thank you, Preeti. Rakhi and Tanya, that was such an interesting and insightful session. It has really brought, I think, all of us as women, as Rakhi, you put it, all of us women on table to talk finance, I think, whenever meet. And we are going to look forward to an ELSA Win group and, and an ELSA Win meetup, I think. That's going to be a great idea
Gossip,
too.
gossip.
Gossip, yeah, win gossip, yes. And I think the first session of our talk series has been quite an insightful session. Thank you so much for bringing Rakhi on, Tanya. And I think we will talk more of finance with Rakhi as time goes by. I think all of us would need more questions answered on it. And thank you so much for all the participants and attendees who made time out to talk finance with us. And we have more sessions on more different topics coming up. So hope that everyone remains as interested and as invigorated to the sessions as we were able to have this one. Thank you so much. And I think we are ready to close the evening today, Preeti. Thank you so much once again, Rakhi, Tanya.
Bye-bye.
Thank you. My pleasure. And see you all soon.
Thank you,
Thank
Rakhi.
you.
Thank you,
Tanya.
everyone.
Thank
Thank
you
you
so
for
much. Thank you,
organizing.
Ashima. Thank you.
Thank
Preeti.
you.
Thanks,
Thank
Rachi.
you.
Thank you.
Thank you, Ashima, Preeti, Tanya, Rakhi.
Thanks.
Thank you. Thank you.